Welcome to Westmount Wealth's Meet the Manager series, where we interview asset managers and look under the hood, asking questions that you want and need to know. Welcome to another installment of the Meet the Manager series. My name is Lorenzo Pederzani, and I'm one of the portfolio managers at Westmount Wealth. According to PitchBook, real asset fundraising in the first quarter of 2024 reached over $26 billion, with an overwhelming majority of that going to infrastructure assets. Infrastructure is popular for a number of reasons at the moment. You've got an intersection with sustainability, stable cash flows, relatively low volatility, and a huge tailwind that's been provided by the Inflation Reduction Act in the US, as well as the Repower EU plan in the European Union, which making infrastructure quite a popular asset class. For those reasons, infrastructure has become a growing percentage of the Westmount Real Asset Fund. So today, we wanted to invite Derek Craig, who's a director at KKR, to join us from New York to talk a little bit about infrastructure as an asset class. Derek, thank you for joining us. Could you explain to the viewers a little bit what is infrastructure and what are some of the main themes that we're seeing?
Absolutely, and thank you for having me. Infrastructure is an interesting asset class because it's pretty large. It's sprawling. There's many different sectors that make up the asset class, but in general, if you were to define it, it ultimately comes down to the essential services that are supporting a local market or a local economy. And that does come through many flavors. And you've actually seen it evolve over time as human needs and wants evolve as well. So many of those different areas would be the traditional infrastructure sectors like transportation, the utilities, or the energy assets of the world. But now you have other areas of infrastructure that have continued to be more important. You have renewable infrastructure, those assets that are helping reduce carbon emissions and help us achieve net zero targets, or digital infrastructure, the data centers, telecom towers, fiber optic networks that are ultimately supporting the digital ecosystem that we all use, as well as you have industrial or social infrastructure. So these different sectors are a lot of the biggest areas that you'll see large infrastructure managers allocate to, and a lot of the opportunities that ultimately make up most of the investment opportunities in the space. But I think there are really three interesting themes that are most important to call out within this series. The first would be this digital realm, because we often hear about the Gen AI opportunity or virtual reality or cloud-based computing networks. And what's interesting about the increased demand for these types of services is that it's going to continue to increase data. And data ultimately has to be stored somewhere. So in order to store and transport data, you need to invest in digital infrastructure like those data centers that I mentioned earlier. So that's a great, exciting theme that we're continuing to see take hold in the market. Another really compelling theme in an opportunity set is the decarbonization of the industry. So you see in decarbonization opportunities through traditional renewables, whether it be wind farms or solar farms or battery storage solutions, as well as through things like natural gas, which are lower carbon emitting forms of energy that are helping to reduce carbon emissions relative to things like crude oil or coal. And then the last thing that we're seeing take hold in the market is this opportunity of what we call deconsolidation. And this is this idea that a lot of infrastructure assets are held on large corporate hands today. And those corporate investors, they're looking to optimize their portfolio and to use the liquidity to be able to invest in higher ROI areas of their skill set. So we can carve infrastructure assets out from these large corporates to be able to manage them more efficiently. Think of them as corporate carve-outs or sale leaseback type of opportunities. So those are some of the main themes, as well as just the broader sectors that impact the infrastructure asset class.
So what is it about today's environment that makes infrastructure such an attractive asset class to you?
It's interesting because what we hear from the institutional market versus individual market is pretty consistent, that people are more and more interested in infrastructure as an investment opportunity. And I think there are really two big things that are driving that. The first is, I'd say, the opportunity set that presented within the asset class itself. And it comes from many of those themes that you discussed in your introduction, that you have a lot of government programs that are helping invest in these infrastructure assets. And if you look at some third-party studies, they're estimating that on average, there's about a need of $7 trillion invested into infrastructure to upgrade and maintain the existing assets that are available to us today and make sure that we're servicing what people need into the future. That is a massive investment opportunity that governments themselves cannot provide the capital for. So it provides a great opportunity for private investors to be able to provide a balance of that capital as well. Now, that comes through many opportunities, but you mentioned the number of $28 billion that's being invested in infrastructure and real assets in general. That is a drop in the bucket relative to the broader opportunity set that needs to be deployed in the space. So I think the first answer to your question is that it's a really exciting opportunity because of the deployment capabilities and opportunities in the market. But the second reason is that from an investor set, the reason you see institutional investors increasing allocations to infrastructure from historically 5% to now 10 to 15% of their overall portfolio allocation is because they're recognizing the benefit that infrastructure can provide to portfolios. You get the benefits when you're investing in these truly essential services that you can have a lower volatile profile. It can be more consistent in the way that it returns capital to investors, and it can thrive in times of market dislocation. So private infrastructure is really attractive because of that lower volatility profile, the consistent cash flows that you typically receive off of these assets that tend to be inflationary hedged, providing that great preservation of purchasing power, as well as just the broader diversification it can provide. I mentioned those sectors that we invest into. A lot of these data center opportunities have no correlation to what might be these renewable opportunities that we see in the market. So the asset class itself provides inherent diversification within it, as well as broader diversification to other asset classes that investors want to invest into. So that's why we think we see more investors in looking to allocate capital to this space.
So you mentioned that there's an inflation benefit to private infrastructure, but often when we look at asset classes that have strong cash flows, they tend to not do so well in a rising rate environment when there's a lot of inflationary pressure. Can you explain what makes private infrastructure or infrastructure in general a bit different?
Absolutely. It's something that comes up often, particularly in this market environment that we're investing into today. Interest rates will have a negative impact, or I should say rising interest rates will have a negative impact on all risk-on assets. And typically at KKR, we do prefer to invest in the equity of infrastructure assets, and we prefer doing so in the private realm as opposed to the public realm. Now, the reason for that is that the assets that we typically pursue, we are looking for opportunities that are going to be more correlated to inflation. And interest rates are typically used as a tool to control inflation. So what you see is that when you have a high interest rate environment, you typically have higher levels of inflation. What that means is that yes, while interest rates are going to negatively impact all risk-on assets, infrastructure can be particularly benefiting because you typically have higher levels of inflation that increase the revenues we're receiving at the portfolio companies we manage. Because they have direct inflationary pass-throughs through their contractual profiles, as CPI increases, we receive more revenue, or because these infrastructure assets have the ability to be a price maker in their local market as opposed to a price taker. So they pass it through to counterparties. Now, those are benefits that you don't necessarily get in the public realm. Because if you look at
For infrastructure, you mean?
For infrastructure, right. Correct. If you're investing in the public infrastructure opportunities that are available, you're still susceptible to investor whims. So that market beta that's going to impact the overall market is ultimately going to impact the NAV of those assets that you're purchasing in the listed market. So I'll give you an example. Utilities, as in a 2022 to 2023 environment, those utility companies on the listed market, those are still great businesses themselves. But as interest rates increased, investors were able to get yield through other sources that had a lower risk to it. And so they traded out of utilities and into things like treasuries or money market funds where they were receiving that yield benefit without incurring any risk to any company underneath it. That's why in the listed market, you see some inherent volatility associated with publicly listed infrastructure assets that we haven't historically seen as much of in the private realm.
So you talked about a lot of the benefits of investing in infrastructure, the stable cash flows, the hedge against inflation, low volatility, but obviously there's risk with any investment asset class. Talk to us about the risks of infrastructure, specifically with private infrastructure.
Glad you asked, because it's a really good point, because we do talk about those benefits often, but it's really important to understand that of course there are risks associated with any investment. Within infrastructure, what we're really managing are typically three types of risks across the board. The first would be the geopolitical climate that you're investing behind. Right now, of course, we all know that it's a very tense geopolitical climate. So where you're deploying capital into those regions that might be more sensitive or exposed to war or other types of disaster is something that you have to be mindful of. Particularly as these are real assets that we're generating cash flow profiles off of. So you need to maintain operations. The second risk would be policy risk. Because we are providing truly essential services to a local market, there might be some government intervention in some of these assets. So the risk would be that either there's nationalization of some of these assets or that they're going to adjust the rate that you're able to charge for those services. Right. So it's really important that you're mindful of the developed market or the strong rule of law that you're investing behind. And the last would be the counterparty risk. You're only able to generate revenue off of a strong counterparty that is continuing to remain solvent. So understanding who's on the other side of that, either contracted cash flow or the service you're providing, to make sure that they're able to provide that revenue that's ultimately underpinning your underwrite, that's crucial as well. And so it's really important as you invest in infrastructure as an asset class to be with a manager that you feel is able to manage those three risks, given the platform and scale and scope and experience that they have.
Listen, that was very informative. Derek, thank you so much for joining us today. Please note, alternative investments are not suitable for all investors, but if you'd like to learn more about private infrastructure or the Westmount Real Asset Fund, please do give us a call. As always, see you on the next Meet the Manager.